For nearly 8 decades, the US dollar has been the backbone of the global economy. Every barrel of oil, every container of goods, and most international investments have been priced in dollars. When one dominant currency is used, buyers and sellers don't need to exchange money into multiple currencies, avoiding conversion costs, exchange rate risks, and delays. Prices become clearer, trade flows faster, and international transactions more predictable, making global commerce simpler, cheaper, and more efficient for everyone involved. But that dominance, once absolute, is slowly eroding, and with it the flow of capital and trade. According to IMF data, the dollar made up 71% of global foreign exchange reserves in 1999. In 2025, it stands at just under 58%, its lowest share in modern history. The euro holds about 20%, the Chinese yuan roughly 3%, and the rest is spread among the yen, pound, and a growing mix of smaller currencies. At first glance, a 13-point drop might not seem dramatic. But on a $110 trillion world economy, it's seismic. It signals a quiet but profound shift. The world is diversifying away from a single monetary anchor. And that shift has a price. When one currency dominates global trade, the system runs efficiently. It's predictable, liquid, and cheap to operate. But if the world breaks into competing currency blocks, it introduces friction everywhere. Economists at the IMF and Bank for International Settlements estimate that such fragmentation could raise global transaction and hedging costs by 0.3% to 1.5% of world GDP annually. That's between $330 billion and $1.6 trillion per year. Gone. It doesn't vanish. It shifts from the real economy, producers, workers, infrastructure, into the hands of financial intermediaries. Banks charging currency conversion fees, traders managing foreign exchange flows, and hedge funds selling protection against volatility. In effect, the world would be paying a hidden friction tax for no longer sharing one financial language. Even at the conservative 1% estimate, that's about $1.1 trillion a year, or roughly $130 per person on Earth, siphoned from productivity into bureaucracy, speculation, and complexity. That's why the dollar's decline matters. It's not just about geopolitics. It's about efficiency, cost, and stability. To understand how we got here, we need to trace how the world found, and may now be losing, its financial greenback king. For centuries, gold was money. It was universally trusted, incorruptible, and finite. Empires minted coins, but value came from the metal itself. Yet gold was cumbersome. As trade expanded in the 18th and 19th centuries, carrying bullion across oceans became impractical. The solution was the gold standard. Every currency fixed its value to gold. Britain's pound sterling, anchored by the empire's trade and navy, became the world's financial hub. A merchant in Bombay or Buenos Aires could trust that a pound was as good as gold. This system created unprecedented stability until it collapsed under the weight of 2 world wars. How? By the early 20th century, Britain's pound sterling had been the world's reserve currency, backed by gold. But after World War I and especially World War II, Britain printed far more money than its gold reserves could support to finance war debts and reconstruction. The pound became overextended. Nations printed money to pay for survival. The gold link snapped. The world needed a new anchor. In July 1944, as war still raged, 44 nations met in Bretton Woods, New Hampshire, to rebuild the global economy.
At Bretton Woods, New Hampshire, delegates from 44 allied and associate countries arrived for the opening of the United Nations Monetary and Financial Conference. Invited by President Roosevelt to the first major world financial meeting since the London Conference of 1933, they will work in the seclusion of this White Mountains resort.
They created the International Monetary Fund and the World Bank, and they chose a new foundation for global finance, the US dollar. Why the dollar? Because America, by then, held 2/3 of the world's gold, had the only intact industrial base, and controlled half of global production. Under the Bretton Woods system, every currency was pegged to the dollar. and the dollar was pegged to gold at $35 per ounce. The arrangement worked beautifully. It brought fixed exchange rates, low inflation, and the predictability businesses crave. For a quarter century, the dollar became the world's anchor, the ultimate measure of value. Global trade quadrupled between 1950 and 1970. Economies boomed. The post-war era of prosperity, the golden age of capitalism, was built on green paper that everyone trusted because it was as good as gold. By the late 1960s, America's strength had turned into strain. America held about 20,000 metric tons of gold in 1950. At first, the amount of dollars in circulation roughly matched that gold value. But as the U.S. financed European recovery, Cold War defense, the Vietnam War, and domestic social programs, it spent more than it collected in taxes. To cover the gap, it printed dollars. Like a bank operating on fractional reserves, the system worked only as long as most countries trusted the U.S. not to overissue currency. But by the 1960s, confidence eroded. President Charles de Gaulle of France, skeptical of America's discipline, began exchanging French dollar reserves for gold, inspiring others to do the same. By 1971, foreign claims on U.S. gold far exceeded what America actually held, about 8,000 tons left. Facing a run on its reserves, President Nixon closed the gold window, ending the dollar's convertibility.
The strength of a nation's currency is based on the strength of that nation's economy. And the American economy is by far the strongest in the world. Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States. Now, what is this action, which is very technical, what does it mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America.
This was a relatively easy step for Richard Nixon to take, even though it was a bit controversial at the time because America produced the majority of its own goods consumption, as he will allude to towards the end of his speech.
Your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar.
The world entered the era of fiat money, where currency value rests on confidence, not gold. Many predicted collapse, but something unexpected happened. The dollar stayed dominant. Its new backing was not gold, but oil. In the 1970s, Washington struck a deal with Saudi Arabia. OPEC would price oil exclusively in U.S. dollars, and in return, the U.S. would provide security and access to its markets. That deal created the petrodollar system, which replaced gold as the world standard. Every nation that needed energy, that is, every nation, needed dollars. Oil traders, central banks, and investors around the world stored their savings in U.S. assets. American Treasury bonds became the new gold, offering safety and liquidity. This arrangement benefited everyone. The world enjoyed stability and predictable trade. The U.S. could borrow cheaply to fund its deficits. Investors had a safe, universal store of value. But beneath that order, imbalance grew. Its main cause is that the U.S. learned it could run perpetual deficits without immediate consequences because the world needed its dollars. USA led the world economically on all sides. In the 1970s, America was still the anchor of the world economy. It produced about a third of global output, led in industry and innovation, and its currency, backed by confidence and oil, defined world trade. Though its gold stock had fallen from post-war dominance to around 8,000 tons, the U.S. remained trusted and powerful, with debt only 30% of GDP. When the petrodollar system began in 1974, linking oil to the dollar, it secured America's financial supremacy for decades. Today, the scene has shifted. The U.S. still leads, but with only a quarter of global GDP, record debt above 120% of GDP, and a world more skeptical of its dominance. Wars, sanctions, and endless borrowing have strained the trust that once underpinned the dollar. America's currency still rules global trade, but a quiet, uncomfortable question grows louder. How long can confidence alone sustain the system? Russia now sells oil in rubles and yuan. China's SIPS network allows payments independent of the Western-controlled SWIFT system. BRICS nations are discussing a commodity-backed settlement currency. Even Western allies, wary of financial sanctions and dollar dependency, are exploring diversification. The world isn't abandoning the dollar overnight, but it's clearly preparing alternatives. The dollar's share of global reserves has fallen by about 20 percentage points since the 1970s. The yuan's share, once negligible, now exceeds 3% and is climbing. Meanwhile, the others category, smaller and regional currencies, has grown from 2% to nearly 10%. The shift is slow, but structural, and once trust migrates, it rarely returns. A fragmented currency world means higher costs and more uncertainty. If the dollar's dominance continues to fade, the global economy could lose up to 1% of GDP each year in extra financial friction, roughly $1 trillion annually. That's more than the world spends on humanitarian aid, climate adaptation, and global education combined. The winners will be financial intermediaries, banks, exchanges, and hedge funds that profit from volatility. The losers will be ordinary nations and people who rely on affordable trade, stable prices, and predictable investment. For almost a century, the dollar has been the invisible infrastructure of global stability. It has been both America's greatest asset and the world's quiet blessing. But every empire's currency, the Roman aureus, the Spanish silver real, the British pound, eventually met its limit. The US dollar is no exception. Its fate depends not only on what the world does next, but on how America responds, whether it restores trust and fiscal discipline, or lets history take its course. And if the dollar falls, the world will face its greatest financial question in a century. Can it survive without a king and still avoid chaos?